Good evening once again, and a hearty welcome to today's webinar. Let me begin by thanking you all for taking the time and interest to join us today on our discussion on the UAE corporate tax. My name is Jyotika Ranjit, and I've been working with Kothari auditors and accountants in the Tax and Compliance Department. Before we proceed to the session, I'd like to give a brief introduction of our company, Kothari Auditors and Accountants, better known as KAA. Established in the year 1992, KAA has been proudly serving in the professional field for more than 30 years, providing management and financial consulting services, including audit, accounting, VAT, and company registration services. KAA operates in two offices located in Khalid bin Walid Street in the Emirate of Dubai and Bank Street Rola in the Emirate of Sharjah. Our associate office, Global Business Services DMCC, which was established in the year 2010 and located in Jumeirah Lake Towers, Dubai, specializes in the formation of global entities, trusts, and foundations in the UAE and worldwide. As you are all aware, the much-awaited federal decree law on the UAE corporate tax has now been officially published by the FTA, and it's time to gear up our businesses to ensure adherence to the law and prepare for its smooth implementation. As always, the KAA GPS group is committed to ensure that our clients are updated of all the new developments in the law, and we therefore have you all here at our yet another webinar on the UAE corporate tax. With this note, I'd like to introduce before you our speakers for the day. It's my privilege to introduce before you Mr. Vipul Kothari, the founder and head of KAA and GPS. He has the distinction of passing the Chartered Accountancy at the age of 21 from the Institute of Chartered Accountants of India and went on to receive gold medals from BK School of Business Management in MBA Finance. We also have with us Mr. Prasad Bhonde, Senior Manager, Audit and Compliance. He is a company secretary in addition to many more professional qualifications and has over 20 years of progressive experience in the professional field. Before I hand the session over to the speakers, please note that the session is being recorded and all the participants are muted. In case you have any questions, please raise them in the chat box and we shall answer them at the end of the session. So without delaying any further, let's move on to the session. Over to you, sir.
Good evening, everyone. Good afternoon. Good evening, everyone. Welcome to this session on corporate tax law, the much awaited federal decree law, which in fact the broad outline which was shared a few months back. Then a public consultation document was floated. And after the consultation document, receiving the feedback, the UAE authority, Ministry of Finance and the Federal Tax Authority has published the much awaited UAE corporate tax law. Though the executive regulations, the cabinet decisions, these are yet awaited, these are pending, and many clarifications which will come eventually from the cabinet resolution will be are still awaited. So once those are coming, we'll have more clarity. However, the corporate tax law which has been published has given a lot of clarity on what form of taxation, how the tax would evolve, and what are the taxable persons, different exemptions which are available, what would be deductible and non-deductible expenditure, and whether the losses would be carried forward or not, and what are the compliance. These clarity has already come in. As all of you are aware, the UAE began its journey to ensure that it is bringing in the regulations in line with the international set standards a few years back. It began with actually the introduction of excise tax, then the VAT, economic substance regulation followed, ultimate beneficial owner regulation was introduced, and then the anti-money laundering regulations were tightened. And this UAE corporate tax is an important piece in that puzzle, which eventually will ensure that UAE is amongst the most well-regulated jurisdiction globally. And as a part of UAE government's drive to ensure that it is reaching those high standards of regulatory framework which are required for international businesses and international financial network, it has brought in the corporate tax law. However, as you are very much aware, UAE always believes in the fact that the minimum regulations, and through those regulations, you ensure the governance of the country and the corporate world. So from that perspective, also, if you see, the UAE Corporate Tax Law is primarily not a very huge piece of legislation. It runs into 60 pages as compared to globally, if you see maybe India or other countries where the tax laws are quite detailed and in-depth. So UAE always believes that keep it simple and more effective. So the timeline, as all of us are aware, that the federal decree was announced on 9th December. The executive regulations cabinet decision is still awaited, which will bring in a lot of clarity on different aspects relating to implementation of corporate tax law. However, the timelines are that effective from 1st June 2023. So the companies which have financial year starting on or after 1st June 2023, they will be liable for corporate tax. So we'll cover those aspects in times to come. So the first section that I'll take is, on the aspects relating to who are the taxable or exempt or persons or qualifying free zone persons. How can you form corporate tax groups? What is the basis of taxation, tax rates, and exempt income or participation exemption? So if we go to primarily the definition of taxable person, it says that any juridical person which is incorporated in the UAE. So primarily it would include a mainland entity or any UAE free zone entity. Then the UAE foreign juridical person which are effectively managed and controlled in UAE would also be considered as resident. So this would mean that if there are entities which are formed overseas, but the control and management of those entities, for example, many of the people over here, they have overseas entities, let's say in BVI Seychelles, but these are being effectively managed and controlled in UAE. So technically the place of effective management control, if it is deemed as UAE, then those also could become resident and hence taxable on their income. So this is one aspect which will definitely need to be looked into by most of the businesses. Then there is natural person which conducts business or business activity within UAE. Now, what is business? The law says that it is any economic activity, whether continuous or short-term, which is conducted by an individual and with a profit motive. So there would be an existence of some system or organization to the activity which is being conducted by such a natural person. However, again, executive regulation would clarify on what type of activities, whether investments would be covered, whether properties would be covered. In all probability, properties may not get covered, though FAQs do mention that it will not be covered. However, we are awaiting the cabinet regulation and the executive decision in this respect. Or there could be any other person as may be specified by the government authority. These would be resident person who would be liable to tax on the corporate profits or on the business income. The second part is the non-residents. The non-residents are the ones which are technically not residents. So they are neither juridical person incorporated in UAE nor foreign juridical person who are managed and controlled in UAE. But such persons, so it could be individual or entities, they have a permanent establishment in the UAE and they derive UAE sourced income, or they have nexus in the UAE. Now again, this nexus is yet to be clarified. One more type of entity which it talks of is unincorporated partnership. Now many a times, there are civil companies which gets registered with the authorities. They are not independent juridical person. They could be just a general partnership between two individuals. Such type of entities will be considered as tax transparent, which would mean that the entity per se will not be considered as taxable, but individual partners who are carrying out this business under the unincorporated partnerships, they will be individually treated as taxable person. So whatever is the revenue, expenses, assets, liabilities will get distributed between the individual partners in ratio of their profit share. And then those individual partners, as a natural person, they will register for corporate tax and they'll have to file the tax and pay the tax applicable on it. Then there are however, these unincorporated partnerships can also apply to be treated as a taxable person. So directly, rather than individuals being taxed in their personal capacity, the partnership entities could apply, and then Federal Tax Authority could consider granting them corporate tax registration as the unincorporated partnership. Then there is family foundation. That could be applied, though family foundations are legal juridical person registered in UAE. However, they could apply to be treated as unincorporated entity. So primarily, such juridical person like family foundation, they could be utilized for some sort of tax planning for personal assets, holding of assets, and for inheritance planning. Now, there is a category of exempt person also specified. Primarily, these are federal or government entities or government controlled entities or entities or persons which are engaged in extractive business or non-extractive natural resources business and which are subject to emirate-wide level tax. Because as you might be aware of, some of the extractive businesses like oil and gas and natural resources extraction are state subject, and they are being taxed by the respective emirate where those companies are situated. So primarily, these companies have been granted exemption from the UAE corporate tax in order to not to have double taxation. Then there are some public benefit entities, investment funds, and private social security and recruitment pension funds. And also certain other juridical persons which are owned or controlled by any of these above, which are stated above. However, one thing to note here is that the banking sector also is taxed by the respective emirate. The banks, foreign banks are taxed by the respective emirates. So primarily, however, no exemption has been granted. So it would appear that they would be liable to corporate tax as well, apart from the emirate level taxation. Now, earlier in the draft which was circulated and the public consultation document, there were confusion regarding whether a free zone entity will be given exemption only if they are carrying out businesses internationally. And if they had mainland business, maybe there was a doubt, or it was stated that it would be taxed on 100% of the income. However, this corporate tax law has clarified this, and it has brought in a concept of qualifying free zone person. So any free zone entity, which is basically where the free zones have granted corporate tax exemption, and such free zone company maintains adequate substance within UAE, it derives qualifying income, which is yet to be defined by and which will come in the executive regulations. And it is not elected to be taxed at a normal tax rates of 9%. It complies with the arm's length transaction and transfer pricing documentation and any other condition that may be prescribed. So a company which fulfills all of these criteria can be classified as a qualifying free zone person. And such free zone entities, whenever they have income, which is qualifying income, now that is yet to be defined, but the expectation is that international business or foreign income relating to these free zone entities, they would be classified most probably as qualifying income. So on that, 0% corporate tax would be levied, and other than qualifying income, so non-qualifying income primarily will be taxed at 9%. So this remains to be seen. The definition of qualifying income remains to be seen. But one thing is clear, that the free zone entities will get 0% tax exemption, assuming that they are granted the benefit in terms of qualifying income, that if they do international business and foreign business. However, all the free zone entities will have to register for corporate tax, and they will need to file tax returns and financial statements in order to claim the 0% tax rate. So it's not that automatically they will be granted this 0%. It is subject to their filing and fulfilling the above conditions. Now there is a question of tax group. In VAT, we have seen that when the companies are under same management and control, so where primarily 50% or more is under the same management control, they are being allowed as tax group for VAT purposes. However, in corporate tax, the definition of tax group is different. It very clearly says that the tax group can only be formed if, let's say, one of the entity, which is a resident juridical person, owns 95%, not 50%. It owns at least 95% of shares, voting rights, and also is entitled to at least 95% of the subsidiaries' profits and net assets. So prima facie, the tax group can only be formed if there is 95% ownership control between the two entities, or a third entity owns two entities to the extent of 95% each, then it could still be classified as a tax group. However, in the tax group, the free zone entities will not be included or exempt because they will have different tax regime. And two other conditions that needs to be fulfilled is that all the group companies which you intend to form a tax group, they should have a same financial year and they should follow the same accounting standards. So this means that an individual owns multiple entities himself, maybe even 100%. It would not be classified as a tax group. You will need a entity, which is a juridical person, which has to own certain other entities to the extent of 95% or more, and then only you could register as a tax group. And that also should not be just ownership of shares, but also voting rights and also share in the profits to the extent of 95% or more. So this would mean that registration of tax group is going to be quite challenging unless and until there is a parent subsidiary relationship between the entities which intend to form the tax group. Now the taxation criteria, primarily, how the taxability would be there. So first, the residents, which are juridical persons, as we have seen earlier, the companies which are incorporated within UAE, whether it is mainland or free zone, they would be taxed on their worldwide income. So having said that, if let's say a UAE resident entity has a branch office overseas, then that also technically will get liable to tax in UAE. However, there is a provision which will come to subsequently that if they have paid tax in a foreign jurisdiction, they can claim a credit of that. Or there are possibilities of exemption also under certain conditions. Then a natural person, so an individual, will be again taxed on worldwide income, but those which are derived from business or business activities which are conducted in UAE. So as far as natural person is concerned, it would be limited to, of course, UAE income from business and business activities, and foreign income generated from business activity which they've carried out in UAE. So primarily, if they carry out business activities within UAE and which gives rise to foreign income, that would get taxed. The non-residents would be taxed only on that component of income or taxable income from their permanent establishment within UAE. So if they have a permanent establishment and which leads to taxable income, that would be taxed. Or income which is sourced in the UAE, or taxable income which is attributed to such non-residents nexus in UAE. Now again, nexus is not been defined, and that will be expected to be defined in the executive regulations. There is another small business relief which is being talked of in the corporate tax law, where it is said that small businesses which are resident and they are taxable person, they can opt and they can apply for getting the exemption, provided their taxable revenue in that tax period and previous tax period has not exceeded the prescribed limit or the threshold. Now, this threshold has not been still defined as yet. So again, that is what will happen in the executive regulations will come to know. And there'll be certain other conditions that will need to be fulfilled. So this primarily, I think, is intended to give exemption to very, very small businesses, which probably would be at a very small level of income, and they do not need to unnecessarily go through the filing requirements and maintaining the records and compliances in accordance with the law. So they'll have very limited compliances in that case. Now, the tax rate, as it was already announced that it would be 9%, of course, above a taxable limit. So up to a taxable limit which is yet to be specified, it would be 0%, and beyond that it would be 9%. However, the limit, the basic exemption of this taxable limit, which will be chargeable to 0%, is not been specified in the regulation, but it is expected that it would be 375,000 dirhams, which is given in the FAQ also. So this is what is expected, that it would be 375,000 dirhams. So up to 375,000 dirhams, in all probability, it would be 0% tax rate. And beyond 375,000, it would be charged at 9% tax rate. Of course, multinational entities, large multinationals, might be subjected to differential rate of tax at a later date and time based on the Pillar 2, which UAE has also adopted and would be implementing it under the base erosion profit shifting project of the OECD. And UAE resident companies which are subject to tax on their worldwide income, as I mentioned, that juridical person, which are entities which are registered within UAE, and they have branches overseas. And overseas branch income also will be liable to tax within UAE at the standard rate of 0 or 9%, depending on the slab they fall into. But they will be allowed to claim tax credit on that foreign tax that they have paid, which will be lower of the tax that they have paid in that country or the corporate tax payable on that foreign income. And of course, the excess, if they have paid foreign tax, it will not be credited or refunded. On the qualifying free zone, as I had mentioned earlier, that the qualifying income will be taxed at 0% and the non-qualifying would be at 9%. Again, qualifying income, what would be covered is yet to be defined. Now, there are certain income which have been specified as exempted income. So those will not be chargeable to tax under the Corporate Tax Law or the Corporate Tax Act. So these would not form part of the taxable income. So those are primarily dividends or any profit distribution which are received from a resident juridical person. So if a UAE-based taxable person, resident or non-resident, they derive dividend or any profit distribution from a UAE-based resident juridical person. So another UAE-based entity, it will be exempt, irrespective of the percentage shareholding in those entities. Then there is dividend or other profit distribution which is received from participating interest in a foreign juridical person. So this again talks of that if a taxable person is holding some shares in a foreign entity, the dividend and profit distribution could be exempt, not necessarily be exempt, but it could be exempt provided they meet some of the criteria of participating interest, which will come to in the subsequent pages. And of course, any other income from participating interest, which is mainly capital gains on sale or transfer of the shares. Then income of foreign permanent establishment, again, subject to certain conditions that could be exempt. And of course, income derived by non-resident person from operating aircraft or ships in international transportation. Again, this is meant mainly for the aircraft, airline industry or such large, shipping industries primarily. Yeah. So participation exemption, as we mentioned, what it says is that if, let's say, a UAE mainland company owns a UAE free zone or mainland company, so primarily any dividend which is earned by the shareholder will be exempt. So it will not be considered as part of taxable income. Capital gain also could be exempt provided they meet the participation exemption criteria, which are given below, which is mainly they should hold 5% or more shares in that company, which entitles them to 5% in capital, voting rights, and dividend. So capital gain is not blanket exemption. It is capital gain is exempted only if 5% or more of shares are held in the entity. And in case the shares are held in a foreign entity, then it would not be blanket exemption even for dividend, of course, and capital gains both. Both would be exempt only if, again, shareholding is 5% and that entity, that subsidiary, is subject to corporate tax of at least 9% in whichever country they are. So if they are not paying any tax overseas, again, then dividend paid by such company will not be exempt. And of course, such shares are expected, held, or intended to be held for at least 12-month period. So these are the conditions, broad level, which needs to be fulfilled to ensure that the dividend and or capital gain exemption is there, and which then does not get added to the taxable income of the taxable person in UAE. So this is primarily one illustration of the participation exemption. So one, it holds shares for uninterrupted period of 12 months. So it holds or it is intending to hold. That is what the law says. Now, in one of the UAE company, which is UAE company, which pays corporate tax of 9%, but the shareholding is only 4% of the main parent entity, UAE mainland company. So this UAE company, when it pays dividend, the UAE mainland company which receives for it dividend will be exempt, because as far as UAE to UAE dividend payments, it is 100% exempt irrespective of the percentage shareholding. However, capital gain would be taxable because the holding, the ownership is only 4% and not 5% or more. In the second example, where UAE mainland owns Indian company, and which owns 10% of Indian company. So of course, we know in India, the corporate tax rate is more than 9%. So technically the conditions are fulfilled. So both dividend and capital gains would be exempt. In third scenario, where UAE mainland company owns Bahamas, where no corporate tax is payable, though it owns 100% of the shares, but because it does not pay any tax in Bahamas, both dividends and capital gains would be taxable. So it will have to be included as a taxable income. This is one illustration whereby, in first tax period, for example, UAE mainland company, which owned 10% of Indian company. And obviously, because Indian company pays more than 9% of corporate tax, dividend is exempt. And of course, if it sells also, capital gains would have been exempt. However, the UAE mainland company, in the second year, before completion of 1 year holding period, it sold off the shares. So technically, it did not fulfill the conditions. So what exemption was taken or availed in the previous year that income will need to be reversed, and then tax will need to be paid on that. So it will get added in the subsequent period. The income will get added in the subsequent period. Okay, that's on the first part. I will now invite Prasad Bonde to share his views and thoughts and share with you on the other part, which is taxable income, deductible expenditure, computation, as well as carry forward of losses and transfer of assets and compliances. I'll hand it over to Prasad. Thank you.
Yes, sir. Thank you very much for the insightful presentation so far. So, ladies and gentlemen, I'll now take you forward to these topics. So the first topic is taxable income. Can we have the next slide, please? Okay, so how do we determine or how do we calculate taxable income? As we have seen that the corporate tax rate will be applicable on the taxable income. So how do we calculate that? So the starting point of the taxable income is the accounting net profit as per the financial statements. So the financial statements which we draw out annually, the net profit of the financial statements will be the starting point. Obviously, the financial statements have to be prepared in accordance with the generally accepted accounting standards. Usually, people in this part of the world follow IFRS, which will be considered for arriving at the net profit. Based on this net profit, you will have to then add or subtract certain adjustments. Those adjustments can be relating to, we will see those adjustments in the next slide. Those adjustments will be relating to unrealized gains or losses, or certain expenses which are not allowable, which are not deductible. Certain transfer pricing adjustments where you do not follow the transfer pricing guidelines. In that case, you might have to adjust the net profit. Certain losses which you might have carried forwards so those losses you might be adjusting to your net profit. So after all these adjustments, whatever profit is left, that will be the taxable income on which you will have to calculate the tax payable. And the period of financial accounting, your financial accounting period will be considered as the tax period. So if you are following the calendar year, that will be your tax period. Now for foreign branch exemption, foreign branches can elect for exemption. They can claim a foreign tax credit for the taxes paid in the foreign country. So if the foreign branch has paid any taxes in the foreign country, they can claim exemption from the foreign branch profits. Obviously, UAE has entered into a lot of double taxation avoidance agreement with various countries, and the corporate tax will take into consideration those agreements. So where there is a conflict, then the relevant international agreement may limit the application of the UAE corporate tax. Obviously, the taxable income will be calculated, or the accounting profit will be calculated based on accrual basis. The law does say that it may allow cash basis of accounting or calculating the profit based on cash basis, but that will be limited to small businesses or individuals. And obviously, they will have to satisfy certain conditions in order to avail that benefit. Now, we spoke about adjustments. Now, in the adjustments, one of the adjustments which you might need to do is regarding expenses. Now, there are certain expenses which are allowed and certain which are not allowed, or certain expenses which are capped. So expenses which are solely for the business purpose, that the taxable person's business, will obviously be allowed as a deduction. But the condition is that it should not be of capital nature, so no capital expenditure will be allowed. Business expenditure incurred to generate non-exempted income. So if you have some exempted income in your financial statements, then any expense which you have incurred for generating the exempted income, that expense will not be allowed as a deduction. Now, this is another important factor for claiming deduction of interest expenditure. So interest on borrowings, there is a cap on claiming deduction. Now, when we talk about interest, the law says of net interest, that is the interest paid and interest paid payable minus the interest received. So net interest expenditure, you can claim maximum of 30% of your EBITDA, that is the earning before interest, tax, depreciation, and amortization. So maximum 30% of your EBITDA is the amount of interest which you can claim as a deduction in the tax period. Now, again, EBITDA is, when you calculate EBITDA, you should not include the exempted income part. That has to be excluded. Now, what happens to the balance? Suppose you cannot claim the entire interest in the current tax period. What happens to the balance? Is that disallowed forever? No. The law does allow you to carry forward that interest and you can carry forward it and deduct it from your subsequent year's profit, and it can be carried forward for the next 10 subsequent tax years. So yes, there is a cap on the interest, but also the law states for carrying forward the interest. There also might be a threshold which might come as far as interest deduction is concerned. So a threshold limit may be specified at a later stage. Entertainment expense, same way, only 50% of entertainment expense will be allowed as deduction. Then one more important aspect is payment to connected persons. Now, as you all are aware, there are a lot of payments we are making to connected persons. Who are connected persons? They are owners of the company. They are related parties of the owners, directors, officers of the company, related party of the officers and directors of the company. Any payments made to them, be it in the form of managerial remuneration, be it in the form of some commission, or be it in the form of management fees, or maybe interest or whatever, that has to correspond to its market value. So basically, how do you arrive at the market value? So again, for arriving at the market value, you will have to refer to the transfer pricing principle, and you'll also have to take care of the arm's length principle in arriving at the market value. So anything which is exorbitant or anything which is not in line with the standard market practices may be subject to rejection. So this will have a very big impact on the taxability aspect of each and every company. So this has to be taken care of by each and every individual, each and every company. And obviously, one more point in that is that the payment which is made to the connected person has to be obviously for the taxable person's business. That is a given. Then there are certain non-deductible expenses. What is not at all deductible from the profit? So obviously, any donation, grants, gifts to a non-qualifying public benefit entity, fines and penalties. If you are paying some compensation for damages and breach of contract, that is allowable, but any fines and penalties will not be allowed. Bribes and other illicit payments will not be allowed. Dividend, profit distribution, similar benefits paid to the owner or taxable person are not allowed. Anyways, dividend is not an expense, it is an appropriation of profit. So that will not be allowed as a deduction. Drawings by the business owner will not be allowed as a deduction. Recoverable input tax, obviously input tax you can recover. So you cannot claim double benefit of getting a deduction here and as well as claiming a refund. So recoverable input tax will not be allowed. Corporate tax imposed also will not be allowed as a deduction, or tax on income imposed outside UAE will not be allowed as a deduction. So how is corporate tax calculated? So here's a simple example. So you have a net profit of 1 million as per your financial statements. In that net profit, we'll have to make certain adjustments based on what we discussed right now, based on what deductions are allowable, what deductions are not allowable. So for example, we got a figure of 200,000, which was not allowable, and hence we added that back to our net profit. So now our total taxable income becomes 1.2 million. 1 million was my actual profit, and 200,000 was not allowed as a deduction, and hence we added that back. So my total net profit or total taxable income is 1.2 million. Now the rate of 0% up to the threshold limit of 375. Again, 375 is not prescribed, but we believe it will be 375. So up to 375, it will be 0%. And above 375, it will be 9%. So out of 1.2 million, 375 is 0%. So 0. And beyond 375, that is 825, we have 9%. So the total tax liability on 1.2 million will be 74,250. Now, the law also has kept provision for withholding tax although the withholding tax percentage right now is 0%, that may be modified at a later point of time, but as of now it is 0%. So what is a withholding tax? So withholding tax is a tax which a UAE resident person has to deduct while paying any amount to any non-resident who is not tax registered here. So that tax is right now 0%. So withholding tax at the prevailing rate to apply on UAE sourced income derived by a non-resident person who does not have a permanent establishment in the UAE, or any other income may be specified in the legislation, in the executive regulation, which is subject to withholding tax. Withholding tax credit also may be taken by the entity who is collecting it in their total taxable income. And any excess withholding tax, if it is paid by the taxable person, can be also refunded. Now, carry forward of tax losses. Now, what are tax losses? Tax losses are basically when our total deductions are more than our income. So we have a loss. Now, in case of loss, obviously there won't be any tax liability. But the provision, the law is quite progressive in nature, that it is allowing us to carry forward those losses for a future period. Many of us know that carry forward of losses provisions are there in a lot of tax legislations around the world, but majority of the legislations give a limit that they can be carried forward a certain period of time. But the UAE Corporate Tax Law has not prescribed any limit, and these losses can be carried forward indefinitely until they are fully set off. Now, but how much there are certain rules, obviously, we need to follow. How much can we carry forward? So we can carry forward the full loss, but we can set off to a maximum of 75% of the taxable income in each future periods. So in the subsequent period, we cannot set off the full loss. We can set off maximum 75% of the loss. Carry forward obviously is allowed if the same shareholder owns at least 50% of the shares. So if the shareholding of the company changes and the shareholding goes below 50%, then the carry forward loss will be restricted. Provided if the company is still running the same activity and same business, then it still can continue the benefit of claiming these losses. Now, there is also provision of transfer of tax losses. Unadjusted tax losses may be offset against taxable income of another taxable person. So if there are two group companies and one company is having loss and the other company is having profit, then the loss of one company can be transferred to the other group company and be set off against their profit. Obviously, there are certain conditions. What are those conditions? Both these two entities or qualifying group, as the corporate tax law uses the word, qualifying group companies, both of them have to be resident person and juridical persons. Either of the taxable directly holds at least 75% of shareholding. They should have at least 75% of shareholding in both the companies. None of them are exempt or qualifying free zone. None of these, both entities are exempt entities or from a qualifying free zone. And they must follow the same accounting year and they must follow the same accounting standards. If these conditions are there, then we can transfer the losses from in between these qualifying groups. Yeah. Then there is also provision in the law for intra-group transfer of assets and liabilities. So if certain assets and liabilities are transferred between two qualifying group companies, then they can also be out of the purview of CT, provided that they are transferring at net book value. So these assets and liabilities have to be transferred at the net book value, which does not generate any sort of gain to either of the party. Then they can be transferred without having a corporate tax impact. There are conditions attached to it. Obviously, the main conditions are those which were seen in the previous slide. that they should not follow. They should be on follow the same accounting period. They should be following the same standards. They should be not exempted or not in the qualifying free zone. All those conditions also remain the same. Apart from that, the condition is that the assets which are transferred have to be held up for a minimum period of 2 years, and the holding between these two companies should be 75% commonly owned. Once these assets are transferred and the transferee does not hold these assets, and they sell these assets or transfer these assets within 2 years, then there is a crawlback provision also that the transfer can be treated as taxable in the year of transfer, and the value will be whatever the present market value of that asset at that point of time will be taken as an income. Now, tax compliance. So every taxable person should obtain a tax registration number, like we have a TRN number for VAT. Same way, a tax registration number for corporate tax will also be required. Then the return filing and tax payment, the law prescribes a period of 9 months from the end of the financial period. So after your financial period or financial tax period ends, within 9 months, you have to make the payment of tax and also file the return. The UAE tax regime is based on self-assessment principle, like VAT filing, return filing. You have to self-assess your taxable income and file the tax return. The authority has a right to ask for the further information. They have a right to ask your financial statements. But at the time of return filing, it is a self-assessment which you have to do and file the return. Option to apply to FTA for clarification in case of uncertain on tax treatment, that is available. Then you have to maintain all your financial records, tax records, TP records, all that for a period of 7 years. So that within that period, the FTA may ask for any clarification documents regarding those corporate tax returns. And qualifying free zone will also have to file tax returns. Even if they are claiming the benefit of 0% corporate tax, they will also have to register and file the corporate tax return within the prescribed period. So there is an example given. So for example, you are following an year end of April to March. Then in that case, your first reporting period or the first tax period will be from 1st April 24 to 31st March 25. And your tax due date of filing the return as well as payment will be 31st December 2025. If you are following Jan to December, the calendar year, then your first tax period will be from 1st January 24 to 31st December 24. And within 9 months, that is on 30th of September 25, you will have to file the tax return as well as make the tax payment. In the similar way, if you're following June as a year end, your first tax period will be from July 23 to June 24. And then 9 months from that day, 31st March 25 will be your first tax return filing period. So that is it from now from me. Over to you, sir.
Thank you, Prasad. So this was on the overview in terms of the taxability, the tax applicability, the computation of tax, and of course, important matter relating to carry forward of the tax losses as well as carry forward of deduction in terms of interest which could not be claimed. Now, these are very important provisions because earlier, primarily, in many of the countries also you have thin capitalization rules, which happens that if the company has very small capital and most of it is borrowed funds and on which interest is being paid, then there are disallowances which are possible. However, one thing which has to be noted here is that this caps the tax interest deductibility on all the borrowings. So not just the bank borrowings or related party borrowings, but on all the borrowings. So primarily any borrowing which is there and interest is being paid, which is more than 30% of EBITDA, it will not be allowed. It will need to be carried forward, and then you need to try to basically claim it in the subsequent years, provided again you don't hit that 30% limit in those years. So that could be one of the concerns specifically for companies which have high borrowings and high leverage. And also issue happens if company is into losses. What happens in that case? In that case, again, deductibility of interest expenditure would be a big issue. So this will need to be looked at and planned in terms of the capitalization and the borrowing. We'll go to the two other very important matters, which is related parties and transfer pricing and general anti-abuse rules, which have come into effect on publication of the tax law. So the related parties have been defined, and those are very, very broad. And it says primarily that any two or more natural person up to 4th degree of kinship or affiliation. So up to 4th degree, not just the 1st degree of relationship, so blood relative. So primarily up to 4th degree of relationship will be considered as related party. And also a natural person with related party which holds directly or indirectly 50% or more in a juridical person, or exercises control. So now control again is very widely defined, which says either 50% or more of voting rights, or ability to nominate 50% or more directors on the board, or ability or right in 50% or more profits, or even significant influence over business of the other person. So if one individual or even the juridical person has these controls, any of these controls, technically it would fall as a related party. And any transaction with the related parties are going to be under scanner. And be it whether transactions with domestic related parties or with international related parties, so foreign related parties. All of these will have to follow certain set transaction and transfer pricing rules and arm's length principle as far as the transactions which are happening. And these are more or less modeled on the OECD guidelines with respect to the transfer pricing regulations and arm's length principle. So what will have to be done is that first, the related parties will have to be identified. And again, bear in mind up to 4th degree of relationship. Once that is identified, then one has to look at that what are the transactions with these related parties, and are these on arm's length principle or not. And these have been defined by multiple methods which are given in the OECD guidelines also. The first one is comparable uncontrolled price method. Now this primarily at a very broad level would say that uncomparable controlled price is, let's say as a company, you are selling to an independent person a particular product at 100 and to a related party, technically then you cannot sell it at anything below 100. Now that is the comparable uncontrolled price method, because you are selling to an independent person at certain price or rendering service at certain prices. And if you technically render or sell at a lower price, then it would not be probably falling under the arm's length principle. And then there could be issues in the revenue, certain revenue being added because the transaction pricing rules have not been followed. Some of the other mechanisms are resale price method or cost plus method or transactional net margin method or transactional profit shift method. So again, not necessarily that one has to follow just one. It could be a one or combination of any of these methods. It would depend from company to company. So again, tax authority could take a view that certain nature of businesses, this particular method would not be suitable and you need to follow, let's say, transactional profit shift method. Then you might need to follow that. So this is going to be very crucial, specifically with respect to both domestic transfer pricing or transactions with related parties or transactions with foreign related parties. And apart from this, all the documentation with respect to the transactions with related parties will need to be again maintained, and this will need to be submitted to the tax authority. And they could also ask for master file or local file where the it exceeds certain threshold in a relevant tax period. So this is one major area, and specifically in UAE, what happens is most of the promoters, they own multiple entities, and there is always bound to be certain transactions between these entities. There could also be sharing of cost and common resources between these entities. Now, how do you allocate it? You need to ensure that these are on very fair arm's length principle basis. Otherwise, there is possibility of certain costs being disallowed or certain income being added to your tax assessment. And that's what, adjustment can be made by authority where the authority feels that the transactions with RPs are not on arm's length basis. Apart from this, one point which Prasad touched upon is connected person. So there are two primarily different definitions. Related parties is a different definition, and connected person is a different definition. So connected person is more wider because it covers the related parties, and it also covers the officers, directors, which are part of the company. And the salaries, for example, which are being paid to the directors, the benefits which are being paid to the officers or directors, these also have to be on the market price basis, so that today, if a managing director who is also an investor draws, let's say, large amount of salary, tomorrow tax authority could say that, okay, if this is professionally run and you hire a CEO, what is the salary that you may need to pay? And is that comparable to what the investor director is drawing? If not, and if it is quite high, they could say that, no, this is not allowable, and the entire or part of it may not be allowed as deduction. And that's why profit or taxable income could go up. So this will need to be carefully looked at. Another important rule which has kicked in with the announcement of the decree, federal decree on the corporate tax, is general anti-abuse rules. In most of the tax jurisdiction globally, there are general anti-avoidance rules. And these primarily talk of that if any transaction is primarily structured or any structuring is created to avoid the taxes, or and there is no valid commercial reason for such arrangements being done, and it is purely for availing the tax benefits and reducing the tax liability, then such restructuring or such arrangements could be again disallowed by the authority. So let's say today, for example, given in the example today, one UAE entity owns a foreign jurisdiction subsidiary on which it receives dividend. And obviously, because it owns more than 5%, it gets a dividend exemption to that extent. But suppose if participation exemption condition is not met in such cases, if it is holding only less than 5%, in that case, dividend full 600,000 will be taxable. So company will have to pay up to 375,000 zero, and then beyond 375,000 on the balance income at the rate of 9%. Now, after this, federal tax law has kicked in. Suppose if you do a restructuring where you split the ownership between two UAE entities, so that in each company you receive 300,000 of dividend, which is below the threshold level of 0%, I mean, below the threshold level which is expected of 375,000. And then it might not be then taxed at 9%, it will be then liable at 0%. Now, if such arrangements are done, it could again come under scanner. There has to be a valid commercial reason for any structuring or changes which are being done. So this is just one example. So primarily, no structuring can be done with the purpose of only obtaining the tax advantage. It should be clearly some commercially valid, justifiable reason for having done such arrangements or any changes. So this is primarily on the broad overview of the corporate tax law and the information what is currently available. As we say, very, very briefly, just to run through what is known currently, effective from financial year which starts from 1st June 2023. Tax groups can be created subject to, again, holding of 95% and other conditions. Dividend exemption would be, dividend income would be exempted subject to again certain conditions. 9% tax rate for most companies above threshold, below threshold 0%. Return and payments within 9 months of end of financial year. Losses can be carried forward and it can be offset against future profits, or it can also be transferred also to the qualifying group of entities. So it is not the companies which are falling in the tax group, because tax group is a different concept, and transfer of loss could be to entities where 75% is held. Qualifying free zone entities would be eligible for 0% on again their qualifying income, not the entire income. Transfer pricing rules and documentation will apply. And the important part is all the records will have to be maintained, including books of accounts, for 7 years. So tax authority, after the end of financial year, another 7 years that will need to be maintained. And if before end of 7 years, if tax authority initiates any assessment proceedings and which has not been concluded, then you'll need to still keep it for a period beyond 7 years as well. So this is broadly what we know at a glance. What is still awaited, the major points they've defined, for non-resident persons, nexus relating to income generated in UAE, that nexus is to be defined. Allowable and non-allowable expenses they have clarified, but more clarity is expected in that. Qualifying free zone, if it maintains substance outside of free zone, so will they still get that qualifying income exemption on the income which is qualifying income? The qualifying income definition is not there. Documentation for claiming exemption. Differential tax rate for multinational corporations, which probably would not be implemented very soon. It might take some time. And of course, how to allocate if a company, specifically free zone company, has qualifying and non-qualifying income, how do you allocate certain common expenses or shared expenses? So these are broadly the clarifications and details which are awaited, which expect that it would come in the executive regulations, probably in coming few months. So the next steps now, from based on what is known, the businesses will need to now start actively planning and preparing for implementation of corporate tax. Probably some companies may have only 6 months, specifically those whose financial year starts on or after 1st June 2023. They have less than 6 months if it starts on 1st June, if 1st July, almost just 6 months. Because if you are maintaining books of accounts as one common entity, you might have multiple entities which you are maintaining books of accounts as one company. That would not be workable now, because every company, every entity will need to register separately, because as we have seen, forming a tax group is going to be a challenge, because unless there is a parent subsidiary relationship up to 95% or more, you won't be able to create a tax group. So each entity will need to register and file separately. So books of accounts will need to be segregated. Documentation. Currently, there might be some expenses which are being paid, let's say in cash, for example, or some expenses for which there might be no logical documentation or reasoning. For example, sometimes commission payments are happening, or certain other expenses are being paid for which no documentation is available. Such expenses will not be allowable, because if you do not have proof that for what purpose the expenses have been incurred, are they genuine business expense or not, and you do not have supporting documents for it, then claiming it is not going to be possible and will add up to your taxable income, and effective tax rate will then go up. So this, again, documentation is needed to be looked at. You have to identify what are the transactions. First, identify what are the related parties and connected persons. Second, along with that, identify what are the transactions that you have with these related parties and connected persons. And then see that are the pricing on arm's length basis, or is the director being paid on, as they call, market value basis. So these are the things, and ensure that you have proper documentation with respect to that. So apart from this, of course, what will happen is you will have to ensure that all the documentation, whether it is with third party or it is with your local suppliers, vendors, they are all in proper order. Earlier, as far as VAT was concerned, the challenge was only to ensure that your revenue related documentation and your input VAT where you are claiming, or expenses on which you are claiming input VAT, they are all in order. But other documents were not being looked at. As far as corporate tax goes, now all the business related transaction documents, whether it's your asset purchase, it's your borrowings, it's your loan agreements, or it's your any sort of expenses or income, will need to be properly supported and documented and ensure that these are for genuine business purposes of the taxable entity. And the most important part also will be looking at now cash flow impact, because obviously after the end of the financial year, within 9 months, the tax filing will need to be done. And along with that, the corporate tax will need to be paid. So obviously this corporate tax is an outgo, it is an expense. And hence, this is not something like VAT where you collect from the customers and pay to the authority. This is something which is going to impact eventually every company's bottom line. And the most important part, again, which needs to be looked at, many people have, from whatever, inheritance purpose, tax purposes, or structuring purposes, they have international companies. They also have local entities where they hold assets. In individual name, they hold assets or properties. Now, what would be taxable? What would not be taxable? Even if it's a foreign company which does not have substance or place in, let's say, BVI, where it is registered and it is being controlled and managed from UAE, will it get taxed in UAE? So, these are very many issues that one will need to really look at. So as far as time, which we feel it is 6 months to probably 1.5 years, it is a short time, and we need to start planning and preparing for it immediately. With that, I would conclude, of course, on the presentation. Just one last thing that we generally suggest, which could be done, is as phased approach, which could be into 4 phases. First phase being, what are the possible impact assessment based on the corporate tax law regulation which has been announced. The law, sorry, not the regulation. Phase 2, of course, detailed assessment, design and planning once the regulation is announced, which is the executive regulations. Phase 3, obviously, once it comes into effect, effective from that date, how do you ensure that you maintain the required records, documents, and paperwork in proper order? So implementation of that. And finally, of course, at the end of the year, financial year, do the tax calculation and filing of the corporate tax return and payment. So these are 4 phases which primarily can be carried out. And of course, our team of experts would be available to guide on any of these services that you might require. So primarily, we are always available. And should you have any queries with respect to the presentation that we have made right now, obviously, we will have question answer session now. So if you have any questions, you can post queries in the Q&A section. So we will address those questions also. And you can also either put it on the raise your hand so we can unmute, so you can ask the question. Thank you very much, everyone, for joining in today, and we'll be glad to answer your questions.
Thank you, sir, for the informative session. We'll now be taking up a few questions which have been raised by the participants. Number 1, for a free zone company which has sales as exports only, but purchases mainly from mainland companies, will they be subject to corporate tax?
Yeah, see, practically all free zone companies or non-free zone companies will be subjected to corporate tax. That is very sure. Now, only thing is, free zone companies will be entitled to 0% corporate tax on the qualifying income. Now, what is classified or what is going to be classified as qualified income is yet to be seen. But understanding more is that, yes, international business, primarily rendering of services internationally or selling of goods internationally might, again, I'm saying might because we are awaiting clarification in executive regulation. It might be entitled to be classified as qualifying income. And if that does, yes, then it would be entitled for 0% tax exemption, subject to, of course, fulfillment of other conditions. Because bear in mind, just having a free zone company doing international business only, or even doing international business and then claiming 0% exemption is subject to ensuring you have substance in UAE. Meaning that free zone entity will need to ensure that it is not just a pass-through entity where documents are coming and just going out. That free zone company will have to ensure substance. Now, substance will be in accordance with economic substance regulation, which clearly mentions adequate expenditure, adequate premises, adequate operations here, and of course the directed and managed in UAE. So these also will need to be fulfilled in order to ensure that the companies are able to claim exemption. And that's where I would like to add one point, because this is very important and a lot of people have free zone companies and mainland companies. Now, free zone companies may not have substance because they work and they might have just flexi desk, for example. They may not have staff to carry out the business operations. Everything is being done by the entire shared staff which are based in mainland. Now we'll have to look at how will free zone company prove the substance, because it does not have office, it does not have its own resources. It will have to then probably enter into agreement with mainland, which provides this. Now, can it be considered as outsourced services under the economic substance regulation and qualify as substance guidelines? Again, will need to be seen. So all these structuring just based on the entity will not clearly be able to say that, yes, it will fulfill the condition, because its qualifying income does not just say that international business, that is only one which will make them as qualifying income. No, there are other criteria which will need to be fulfilled.
Thank you, sir. Next question. Panama company having bank account in the UAE and books are also kept in the UAE. Is any tax coverage does it be covered under the corporate tax law?
This is, again, very interesting, because many, as I mentioned, many individuals or entities have companies internationally. Now, these companies are in jurisdiction where there is no substance. Like, for example, Panama or BVI or Mauritius or Seychelles, or, you call any tax haven primarily. They work on a similar concept where the company gets registered in one registered agent's office where thousands and thousands of companies are registered in a small office. And there are no shareholders, directors residing in that jurisdiction. All decisions are being taken from UAE if the director is residing in UAE. So having a bank account is not the criteria for that company being taxed in UAE. But having management and control situated in UAE will be the criteria to determine if it would be taxable or not. And from the general experience, all such companies which do not pay, because again, problem is, see, these countries don't levy any tax, and UAE very clearly says that it would be taxable, and you might be able to claim, let's say, foreign tax exemption if suppose it had been paid there, but there is no such tax exemption possible also. So technically, these companies could be classified as, foreign juridical person, which are effectively managed and controlled in UAE. And that's because under that, it could become a resident person liable to tax.
Thank you, sir. Is there a list of free zones that are specified that qualify under the qualified free zone persons, or does it apply to all the free zones?
Nothing specifically yet. See, all of these would come in the executive regulation. And again, you have to see each and every free zone has different, at the time of the free zone being set up, there were different exemptions being granted. Some free zones have 50 years from the date of free zone starting the operations. Some free zones give 50 years or whatever, from the date company gets registered. So every free zone decree or regulation specifies different corporate tax exemption. So in all probability, one will have to look at that and the executive regulation, which, or, some a decision will come, ministerial decision, which will specify which free zones and for how many years exemptions would be available.
This question, our company has 4 retail outlets in Dubai and Sharjah, and stocks are transferred between these outlets, which are branches, without any profit or financial terms. It's just inventory transfer, and how does transfer pricing affect this?
Okay, one point I think probably we have missed in covering is one, see, every company might have, let's say, a UAE entity, UAE mainland entity might have branches in Sharjah, Dubai, Abu Dhabi, Ajman, all these. Now, as long as these are branches, these are considered as part of the main entity. So these are not considered as part of separate entity, taxable entities. So they technically, if it is branches of the UAE registered entities, they don't have to register separately. And if they're not registered separately as taxable person, they come within the same taxable entity, then technically there's no question of transfer pricing because it is just transfer, intra-group transfer. Just transfer within the group, intergroup, they're just transferring from one branch to another, from one mainland to branch to another, again back to mainland.
Okay, sir. One of the companies is registered in free zone. The other companies with the same shareholding paid management fee to the company which is registered in free zone. Will that come under exempt income?
Doubtful, because again, the income that free zone company, management fee income that free zone company gets is from mainland. So technically it is not a foreign sourced income. So there is high amount of doubt that it will not be considered as qualifying income, and hence it will not be charged at 0%, but it will be charged at 9%.
Will transfer pricing need to be separately audited? Valuation requirements from which valuer for ascertaining market value for related parties? And if the taxable person is not a company, will all the requirements of RPS still be applicable?
See, again, in this case, UAE, they have not specified exactly that whether you need to get the transfer pricing documentation audited. Even for financial statements which have to be submitted, there is no specific mention that whether it has to be audited or it has to be certified financial statements. So these are the things which will come up in the executive regulations. So currently, as of now, there is no specific mention of whether it has to be audited or certified or not transfer pricing documentation. But as I believe, see, UAE likes to keep things simple and rather than making things more complicated. And as we have seen in VAT also, there are not too many requirements unless assessment happens, and financial statements are requested, audited only when assessment happens. So generally, I think I am assuming that in majority of cases, maybe audited financials, except for free zones, may not be a mandatory thing, or even transfer pricing documentation audited may not be a mandatory thing. I mean, this is my assumption. Of course, we have to await the regulations.
In case of an MNC company registered in safe zone, where 95% of the purchase of goods is from related parties and resale to third parties, how will the transfer pricing need to be done?
So a free zone company is buying from related party, which is mainland company.
I assume it's foreign parties.
Okay, foreign parties. Yeah, so see, no, because it mentioned 95%. So assuming if it is mainland and free zone, and let's say mainland owns 95% of free zone, still you cannot form a tax group, because tax group cannot have a free zone entity as a tax group person. So it will be both registered independently. Since it both will be registered independently, definitely because it is a related party more than 50%, transfer pricing will be applicable. Whether it's domestic or it is international, transfer pricing will be applicable.
Thank you, sir. If the same owner owns companies in Dubai DMCC and another company in Saudi, what will be the implication with respect to corporate tax?
Related party transactions, because same owner owns both the entities. So any transactions between two entities will come under the preview of transfer pricing and arm's length principle. So that they will need to fulfill. If those are not fulfilled, their taxable income could be readjusted by the tax authority.
Next question. Our main office is in Spain and we are only a free zone dealing in digital marketing. Sorry. Our main office is in Spain and the UAE entity is only a branch of the Spain entity and all our expenses and transactions comes and processed in Spain. Are we covered in the corporate tax?
See, corporate tax per se covers each and every entity which is set up, which carries. So it's basically, a foreign entity which is being managed and controlled in UAE primarily. So it has a place of establishment and all that also. So it will get covered because eventually it is with some sort of a profit motive. Now, whether they earn profit or not is a different part, because they are not recharging on cost plus basis. However, now when this corporate tax kicks in, and let's say there is just a cost recharge happening without any profit being added, there is a possibility of violating the transfer pricing regulation because you are rendering a service to your group company or to your related party, wherein you are not charging them on an arm's length principle because you are just charging them cost basis. So technically, there could be a transfer pricing issue, and definitely they might have to then charge revenue and then pay corporate tax.
Thank you, sir. Next question. How does an individual shown as a manager on trade licenses of multiple companies be affected by the corporate tax, where he is not a shareholder or a partner in any of those companies?
Prasad, would you like to take that? Connected person? It's mute, I think.
So basically, he will be treated as a connected person, and any payments made to a connected person will be subject to that. It is in line with the market value, and anything paid above the market value will not be allowed as a deduction in the corporate tax calculations.
Thank you, sir. Next question. We have an ADGM SPV that owns 5 JAPSA SPVs that each own residential real estate assets earning rental income. How would we be taxed?
See, a legal juridical entity are all technically considered as a resident taxable person. So they will need to register for corporate tax because there is no specific exemption granted to offshore. There is no mention of any offshore. It says all, including registered in free zones. So I believe that, all entities, whether it's offshore or onshore, they will have to register, and then probably if they have certain qualifying income, they might be able to claim for the exemption.
Next question. If both the companies are based in a free zone, can they be considered group companies?
There's no mention of group companies between the free zone entities. It only talks of, mainland. So free zones cannot be part of the tax group.
Next question. In case of a dormant company that's not generating any income, or in case of a company that has income not exceeding the threshold, would they be also required to file the corporate tax returns given that they don't cross the threshold?
Prasad?
Yes, corporate tax return will be, corporate tax registration will be necessary for all companies, and corporate tax return will be required to be filed by all the companies, provided if you are a qualifying free zone, you can opt for the exemption, but still you will need to register and file for the corporate tax return.
Thank you, sir. Next question. What is the tax treatment of long or short-term capital gains? Are different rates applicable to them?
No.
There's no concept of long or short-term capital gains in UAE. It just says that if you're holding more than 12 months and then you sell, and if you have that participation exemption in terms of if you are holding more than 5% of shares in that company, 5 or more percent in that company, then you might be able to get the exemption on capital gain, 100% exemption. But like India, you don't have that, short term gets taxed at a different rate, long term gets taxed at a different rate. There's no concept of long and short term over here.
Thank you, sir. Will the financial statements need to be submitted along with the corporate tax returns?
No, there's nothing specified in that. Obviously, the format of the corporate tax return and what documents needs to be provided is not specified as yet. But yes, audited financial statements definitely will be required to be filed. Now, whether you require audited financial statements or just management certified financial statements would be okay enough, remains to be seen.
Thank you, sir. I think that's all with the open questions. We've already answered a lot of questions that have been raised in the box. So I think.
Are there any? I think there are a few hand raises, so we can just unmute. I think first one, Mr. Srinivas Rao. I think you raised the hand. If you have a question, please unmute yourself and you can ask the question. Mr. Srinivas Rao, are you there? If you wish to ask the question, you can unmute yourself and ask the question. Maybe he's not there. Okay, then the next one is Suzanne Matthew. You have raised hand. I believe you wish to ask a question. Please unmute yourself. Ms. Suzanne Matthew, you can unmute yourself if you wish to ask the question.
Yes, I just wanted to ask, it's that same question has been repeated. It's that one of our company, the main headquarters is in outside and we are based in DMCC. So are we taxable or not?
Outside meaning UAE or overseas?
Outside, overseas.
Yeah, see, overseas, of course, will not be generally taxed unless and until that entity is being controlled and managed from UAE. So you'll have to see now that foreign entity, one, is it a branch office or is it independent entity? If it is a branch office, yes, it will get taxed in UAE with the parent entity. If it is independent entity, foreign entity, it will not be taxed normally unless it is being controlled and managed from UAE. And DMCC entity, yes, will be liable to tax depending on whether they have qualifying or non-qualifying income.
Okay, thank you.
Thank you. Next one, Mr. Suhail Siddiqui. If you wish to ask a question, you can unmute.
Yeah, hi, Vipul. You mentioned just a few moments back that a free zone company cannot be part of a tax group. The question is, we are a free zone company in safe zone, but we don't operate as a free zone company. That means we pay all the customs. We're here because we own property inside the free zone. We've made a building of our own. We warehouse our stuff here, our stock. And then we deal with our companies in Dubai mainland and Sharjah mainland. Can we not be part of a single tax group? We are inside the free zone, but we don't operate as a free zone company.
Not really. See, the tax group part does not specify about whether free zone entities can create a tax group. It is primarily, free zone entities cannot be part of the tax group. So you'll have to register independently all these entities.
Thank you.
Thank you. We'll just wait for 2 minutes. If anyone has any questions, you can raise hand or post it in the Q&A and we'll be glad to answer. And if not, we thank you everyone for joining in today and sparing your valuable time. Definitely we, myself and my entire team is available to guide and assist you with corporate tax implementation. Should you require any assistance, please feel free to reach out. And if you also wish to have the presentation or link to the recording, also you can drop in an email to us and we'll be glad to share that. Thank you very much, everyone. There is one raise hand, Mr. Afaq Ahmed. You can unmute yourself and ask the question.
Good evening, sir. This is Afaq from Tasra Group. The concerned question regarding the same as Mr. Suhail Siddiqui asked. if we registered our free zone entity as a separate entity, can we adjust the loss, because we are not making any kind of profit in this entity, which is the operation we are doing in free zone? Can we adjust that loss with our mainland companies?
No, unfortunately, no.
But being the same owners, the ownerships are same for all three companies.
Yeah, you're right. But again, the transfer of losses provisions clearly states, it cannot be a free zone entity. Okay.
Okay.
And
thank you. Mm-hmm.
Yeah. Also, I'm on the Q&A. I'm just posting the email ID on which you can send in your request for presentation or for the link to the session recording of the session. It's info@gbsei.com. So anyone wanting to have the presentation or the link to the recording, you can send an email on info@gbsei.com. Thank you very much, everyone, for joining in today. Thank you. We'll close the session. Thank you, everyone.
Thank you.
Thank you.